Welcome to another TCP walkthrough video. I'm Logan, and in today's video, we're going to be going over the advantages and disadvantages of different retirement accounts. But we're going to be doing it the SuperfastCPA way, which is diving straight into questions. If you don't know much about our strategies, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training. We teach the key ingredients to passing the CPA exam, and again, it's only 1 hour, it's free, and it will save you so much time struggling with your process. Also, just letting you know, we will only be going over 5 questions in this video, but Superfast CPA members will have access to the full 10-question video when we post it in the members forum. So again, if you like this, you can get more of it by becoming a Superfast CPA member. With that said, let's dive straight into the questions. Alright, here we are at question 1, and just letting you know as we dive into these questions, we're mainly going to be focusing on IRA accounts in this video because that was the easiest thing to compare. The reason for that is because this is based off of a topic in the blueprints that's an application topic that is about comparing the advantages and disadvantages of different retirement accounts. So again, we're trying to compare the different advantages and disadvantages of each of these retirement accounts, which we're mainly focusing on IRAs in this video. If you want to learn more about some other retirement accounts, I made a few retirement account videos a while ago, and I will link those in the description of this video so you can look at those as well to also know what some of the disadvantages and advantages are of those retirement accounts so you can then be more prepared for this topic on the exam. With that said, let's read question 1. Which of the following statements best describes the advantages and disadvantages of using a traditional IRA for retirement planning? So, if you don't know much about traditional IRAs at this point, that's okay. Let's go ahead and dive straight into the answer to start learning about traditional IRAs. Okay, the answer is that traditional IRAs provide tax-deferred growth and tax-deductible contributions which can lower an individual's current taxable income. So those are some advantages. However, withdrawals in retirement are taxed as ordinary income, which could be a disadvantage if the individual is in a higher tax bracket during retirement. So these are some basic advantages and disadvantages. Let's read a bit more of the explanation to get a bigger view of traditional IRAs. Traditional IRAs offer immediate tax relief by allowing tax-deductible contributions, which reduce taxable income for the year the contribution is made. The growth of investments in a traditional IRA is tax-deferred, meaning you pay taxes later, meaning taxes and dividends, interest, and capital gains are not paid until funds are withdrawn, usually during retirement. However, since withdrawals are taxed as ordinary income, if the individual is in a higher tax bracket during retirement, the taxation on withdrawals could be a significant disadvantage. Another advantage is that the wide range of investment options available in traditional IRAs allows for flexible investment strategies tailored to individual retirement goals. However, the primary drawbacks of traditional IRAs stem from their tax structure in retirement. Required minimum distributions, or RMDs, beginning at age 72 can force withdrawals regardless of whether the income is needed, potentially increasing your tax liability. Early withdrawals before age 59 and a half usually incur a 10% penalty plus income taxes, and contribution limits and restrictions post 70 and a half, and that's the age, can limit the utility of the account for older savers. So overall, traditional IRAs, something that a lot of people use. The advantages are that it's tax-deferred growth, you can deduct your contributions, and it's pretty flexible. A lot of people can contribute to it. However, there are some drawbacks. You have RMDs, you have a penalty if you withdraw early, and you can't contribute as much once you get to 70 and a half. And this is kind of what the video is going to be like. We're going to look at each IRA, look at the advantages and disadvantages of each one, and then on question 5, we'll see if you've learned what the different kinds are so that you can pick which one is the most advantageous in the scenario. So let's go to the next question. Okay, here is question 2. Emma, age 30, is considering opening a Roth IRA. She expects her income to increase significantly in the future and believes she will be in a higher tax bracket by the time she retires. Emma plans to contribute $6,000 annually to her Roth IRA. She chooses a mix of stocks and bonds that average a 7% annual return. At age 65, Emma wants to start withdrawing her savings tax-free. Considering Emma's situation, which of the following statements best reflects the benefits of a Roth IRA for her retirement planning? Okay, we've talked about Roth IRAs in other videos. If you know what a Roth IRA is, you probably know the answer to this. If not, that's okay. We're going to go to the answer to learn a little bit about Roth IRAs. Okay, the answer is A. Emma will benefit from tax-free withdrawals on her investment gains and her contributions, which is ideal since she expects to be in a higher tax bracket during retirement. So let's read about Roth IRAs. They are different than traditional IRAs. A Roth IRA is particularly beneficial for Emma because her contributions are made with after-tax dollars. meaning she pays taxes on the money that she invests up front. Since Emma expects to be in a higher tax bracket in retirement, the Roth IRA allows her to withdraw both her contributions and investment gains completely tax-free, avoiding higher taxes later. Unlike traditional IRAs, Roth IRAs do not have required minimum distributions during the owner's lifetime, allowing the investments to continue growing tax-free as long as she chooses. One of the unique advantages of a Roth IRA is the ability to withdraw contributions, but not earnings, at any time without taxes or penalties. This feature effectively makes Roth IRA contributions a form of liquidity reserve while still potentially growing tax-free if left untouched. And what that means is the money you're putting into a Roth IRA is already taxed. So if you take out what you've contributed, there's no penalty because, again, you've already paid taxes on that. Now, if you take out earnings early, then there may be a penalty on that. But again, this allows you to kind of be a little bit more liquid with your retirement account because the money you put in has already been taxed, so you can take it out as long as you're not taking out earnings. However, there are some disadvantages. Roth IRAs limit how much money you can put into them each year, and it's very limited. Typically, the amount is relatively modest, allowing only around $6,000. It changes with time, but it's usually around there. There are also income limits for contributing to a Roth IRA. If you earn too much, you might not be able to contribute at all. So the biggest disadvantages of Roth IRAs is that you can't contribute very much compared to other retirement accounts and other IRAs. And also, if you make too much money, you can't contribute at all. Okay, let's go to the next question. Okay, here is question 3. Jacob is a self-employed graphic designer looking to set up a retirement plan that allows him flexibility in contributions due to his fluctuating income. He is considering a SEP IRA because of its higher contribution limits compared to traditional retirement accounts. Which of the following statements best reflects the advantages and disadvantages of an SEP IRA for Jacob? So again, if you don't know much about these different IRAs that we're talking about, that's okay. That's why we're looking at these questions. That's the whole point of doing the questions first is, even if you don't know what's going on, the question will teach you what you need to know. So if you know the answer, go ahead and answer that, but let's go ahead and look at the answer together if not. Okay, the answer is a SEP IRA allows Jacob to contribute significantly more each year compared to traditional IRAs, offering excellent tax deferral benefits. However, he must make equal contributions for all eligible employees, which could substantially increase costs as his business expands. So this is very different from a Roth IRA and a traditional IRA. Let's read about it in the explanation. A SEP IRA is particularly advantageous for Jacob due to its high contribution limits, which are significantly higher than those of traditional or Roth IRAs, allowing him to save more of his income in high-earning years and benefit from tax deductions. The flexibility to adjust contributions based on annual income is ideal for someone with fluctuating earnings. However, a potential drawback is the requirement to contribute equally for all eligible employees if he hires others, which could lead to higher costs as his business grows. For example, this means if Jacob decides to contribute 10% of his own compensation to his SEP IRA, he must also contribute 10% of each eligible employee's compensation to their respective SEP IRAs. This requirement could make SEP IRAs less appealing if Jacob plans significant business expansion with multiple employees. A SEP IRA is a retirement plan primarily designed for self-employed individuals and small business owners. One of its key features is that only the employer makes contributions to the SEP IRA. Employees cannot contribute to their own SEP IRA accounts. The reason for this is it just simplifies the management of the account. But again, that puts all the responsibility on the employer and they can choose. So if Jacob wants 10% to his SEP IRA, if he has employees that are qualified for the SEP IRA, he also has to contribute to theirs. But if he feels like he can't, then he won't do those contributions, which is kind of a disadvantage for the employees because they can't contribute to their SEP IRA. And if Jacob doesn't, then there won't be any contributions that year. So a little bit different than Roth IRA and traditional IRA, mainly because it's for self-employed people or for small business owners. All right, we learned about SEP IRAs. Let's go to the next question. Okay, here is question 4. Linda owns a small boutique with 15 employees and is exploring retirement plan options that are straightforward and beneficial for both her and her employees. She is considering a simple IRA due to its suitability for small businesses with fewer than 100 employees. Which of the following statements correctly reflects the characteristics and requirements of a simple IRA? Again, if you want, you can read through these. You probably should read through the responses, and hopefully you've been doing that up to this point. So pause the video if you need to do that. But if you don't really know what a simple IRA is, then that's okay. We're going to dive straight into the answer to learn about this. Okay, the answer is that simple IRAs are well suited for small businesses like Linda's and require mandatory contributions that are 100% vested immediately, ensuring employees have full ownership from the outset. Employees and Linda must also be aware of the required minimum distributions that begin at age 72. So just like traditional IRAs, simple IRAs do have required minimum distributions. Let's read about it. Simple IRAs are ideal for small businesses, like we know. One of the key benefits is the mandatory employer contribution, which can be either a match of employee contributions up to 3% or non-elective contribution of 2% of each employee's salary. These contributions are 100% vested immediately, meaning employees have full ownership of these funds as soon as they are deposited. Again, we just read that. Additionally, simple IRAs, like other retirement plans, are subject to required minimum distributions starting at age 72, ensuring that retirement plans are eventually drawn down. So simple IRAs are kind of like a traditional IRA through your employer, but it's more for small businesses. And the cool thing about it is that the contributions are 100% vested immediately. Okay, we learned a little bit about simple IRAs there. Let's go to the next question. Okay, here is question 5. And this question is kind of testing you to see what you've learned from the previous 4 questions to see if you know which would be best in this situation. Maria runs a successful consulting business with 50 employees. She's looking for a retirement plan that not only allows her to save significantly for her own retirement, but also offers flexible employer contributions due to the variability in yearly profits. Maria wants to provide a retirement benefit to her employees that would encourage retention and reward loyalty, but also requires minimal administrative burden. Which retirement plan option makes the most sense for Maria based on her situation? Okay, so this is talking about somebody who has employees, so it might not really be the traditional IRA or the Roth IRA. Would it be the SEP IRA or the simple IRA? We just learned about those, so again, if you need to, pause the video, think about it, and when you're ready, come back, we'll look at the answer. Okay, the answer is that a simple IRA would be best. The simple IRA is most aligned with Maria's needs, providing a balance between employer and employee contributions. Remember, SEP IRAs don't allow employee contributions, which enhances engagement and retention. It offers immediate vesting, which is attractive to employees, and the mandatory employer contributions can be managed as a fixed expense, predictable despite the business's profit variability. Additionally, the administrative requirements are less burdensome compared to options like SEP IRAs, which, while allowing higher contributions, do not offer the same level of involvement from employees. Okay, now that we've gone over these 5 questions, before we go any further, let's do another part of the process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice topics and things that keep popping up. These are the different things that you've seen multiple times throughout the questions. So you obviously know they are important, so you make a pillar topic out of them so you can remember it for later. Let's go to the pillar topics for this video. Okay, here are the pillar topics for the video, and this is kind of a condensed version of the things you've learned, the things that are most important so that you can remember them for later. For traditional IRAs, one of the main advantages is contributions to traditional IRAs may be tax deductible, reducing taxable income for the year, and investments grow tax deferred until withdrawal. One of the disadvantages is that withdrawals in retirement are taxed as ordinary income, and early withdrawals before age 59 and a half typically incur a 10% penalty along with income tax. Now, Roth IRAs are awesome. Their contributions are made with after-tax dollars, allowing for tax-free growth and tax-free withdrawals in retirement, providing a significant benefit if you expect to be in a higher tax bracket later. One of the big disadvantages, though, is that the contributions are not tax deductible, so there's no benefit to doing it in the current year. It's all later on. And there are income limits which may restrict high earners from contributing. And also, you can't contribute very much to a Roth IRA. SEP IRAs allow higher contribution limits than traditional or Roth IRAs and is simpler to manage with fewer administrative requirements than other employer-sponsored plans. One of the biggest disadvantages, though, is that it requires equal contributions to all eligible employees, which can significantly increase costs as more employees are hired or salaries increase. Also, employees cannot contribute, only employers or self-employed individuals. So only the person who started the business, who's self-employed, can contribute to themselves or to their employees. The employees cannot. Finally, simple IRAs. These are designed for small businesses, but they're different than SEP IRAs because they allow both employer and employee contributions, and employer contributions are mandatory and 100% vested immediately, enhancing employee retention. One of the big disadvantages, though, is that the contribution limits are lower than other employer-sponsored plans like 401ks, and mandatory employer contributions could become a financial strain for the employer. Now, again, we only went over IRAs in this video because they're the easiest to compare, and a reminder that this topic that we're going over is an application topic from the blueprints where you're trying to compare the disadvantages and advantages of different retirement plans. We only went over IRAs, so if you want, you can go down to the description and I will link videos about the other types of retirement accounts so that you can learn about them as well and compare the advantages of those and the disadvantages of those so that you can be ready for this topic on the CPA exam. Now, with all that said, that is the end of the video. Thanks for watching. Make sure you go check out our free 1-hour webinar training on SuperfastCPA.com. We teach the key ingredients to passing the CPA exam, and again, it's free and it's only 1 hour long. If you liked going through these 5 questions, just remember that Superfast CPA members will have access to the full 10-question video when we post it in the members forum. If you liked the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.